Hi, welcome back to Joe Blogs. In today's episode, I want to talk about the Chinese economy. China is the second largest economy in the world, and up until the global financial crisis struck in 2008, it was growing at an exponential rate. However, China's rate of growth was severely impacted by the global financial crisis and has been in decline since 2010. And the COVID-19 pandemic had a severely damaging impact on China's growth, both in 2020 when it first emerged and impacted the whole of the global economy, but also in 2022 as China retained its zero-tolerance policy and continued to put major cities into lockdown. The zero-tolerance policy was finally abandoned in December 2022, and economic forecasters were expecting 2023 to represent a year of significant growth. The first 3 months of 2023 proved to be successful for China. However, over the course of the last couple of months, we've seen a significant slowdown in China's growth, and the economic forecasters are now rapidly revising downwards their expectations for 2023. So in today's video, I'll have a look at exactly what's been happening with GDP in China over the course of the last 25 years and what the current expectations are now for 2023. We'll have a look at the latest figures for industrial output and retail sales, both of which have come in disappointingly below market expectations. We'll look at what's happening with China's exports because China is the world's manufacturer and therefore the economy has a high dependence on its exports. And rather shockingly, exports fell year on year in May. We'll also have a look at what's happening with imports because China imports a lot of raw materials which it then uses in its manufacturing processes. And once again, we saw an unexpected fall in imports, which represents further bad news. We'll have a look at what's happening with the Purchasing Managers Index, which gives us a strong indication of what the economy is likely to do over the next 3 to 6 months. We'll touch on what's happening with inflation in China, and unlike the rest of the world, China has a problem that it doesn't have enough inflation. The Chinese economy is actually experiencing deflation at the moment, and that comes with its own problems. And then finally today, I'll wrap up with my summary. So what I think is likely to happen in the Chinese economy over the course of the next 3 to 6 months, and what the implications are for the global economy. This chart shows the annual percentage increase in gross domestic product in China over the last 25 years. And I think what's worth noting initially is that China has seen year-on-year growth in GDP in every one of the last 25 years. So in real value terms, China hasn't experienced a recession. However, what you need to take into account is that China is a rapidly growing and expanding economy. We're talking about a country that has a population of over 1.4 billion people. And over the last 25 years, the authorities have focused their energy on building their industrial output, essentially becoming the manufacturing heartland of the world. So given that context, you may be thinking that the fact that China is delivering year-on-year growth in its GDP means that there aren't any problems. But unfortunately for China, that isn't the situation because the country has geared itself up to continue growing rapidly. So if we have a quick look at this chart, you can see that at the end of the 90s, GDP was growing at a rate of around 7.8%. However, between 2000 and 2007, the rate of GDP growth grew rapidly and hit a peak of 14.2% in 2007. Now, if you know your history, you'll know that 2007 was the year prior to the global financial crisis. The global economy was on fire. Virtually every country in the world was doing really well. And because China was supplying a lot of manufactured goods and selling lots of exports, it was doing extremely well. However, unfortunately for the global economy, that level of growth wasn't sustainable, and 2008 was when the global financial crisis struck, and we saw recession hit most countries in the world. But as you can see from this table, China actually saw growth of 9.7% in its GDP in 2008, which was actually its lowest level of growth since 2002. And effectively, for a growth economy like China that was expecting double-digit growth, this was like a recession. And you can see that in the following year, 2009, GDP growth fell further to 9.4%. It then bounced back into double digits in 2010 when the global economy started recovering. However, between 2011 and 2019, China experienced year-on-year reductions in the growth of its GDP, and in 2019 recorded GDP growth of only 6%, which as you can see was the lowest level for more than 20 years. Now, as I mentioned at the start of the video, in 2020, when the COVID-19 pandemic hit the world, the whole global economy came to a grinding halt, and China only managed to record GDP growth of 2.2%. Now, in 2021, the global economy came bouncing back, and China benefited from this and saw GDP growth of 8.1%. However, in 2022, the Chinese authorities decided that they wanted to maintain their zero tolerance policy. When they found one case of COVID, they would lock down entire cities. So sometimes you would have 20 or 30 million people in lockdown as a result of one case being recorded. So quite a draconian way of dealing with things. And that had a hugely detrimental impact on China's GDP. And growth in the year only came in at 3%, which was the second lowest recorded figure in China's history. Now, the zero tolerance policy has now been abandoned, so China is operating in the same way as the rest of the world. And prior to the start of 2023, the expectations were that China would see GDP growth of somewhere between 6 and 6.5% for 2023. However, as a result of the poor performance of the Chinese economy in April and May, those forecasts have now been downgraded. Nomura, the Japanese bank, recently cut its 2023 GDP forecast to 5.1% growth for China from the previous level of 5.5%. And this downgrade follows similar moves by UBS, Standard Chartered, Bank of America and JP Morgan, who are forecasting a range of between 5.1% and 5.7% growth versus the original forecasts of 5.5 to 6.3%. Now, you may be thinking, well, those revisions aren't particularly severe. We're only talking about 0.5%, so it shouldn't really make that much difference. But what you need to bear in mind is that China is the second largest economy in the world, and in 2022 had total GDP of around $19 trillion. So 0.5% equates to around $95 billion. But it's not just the impact of the loss of $95 billion worth of growth for the global economy. What you have to think about is the multiplier effect. Because China is trading with the rest of the world, it delivers a lot of exports and a lot of imports. So when the Chinese economy shrinks, firstly, it means it will be buying less, so it will be importing less of the raw materials that it needs to feed all of its processes. And also it will be selling less. And of course, when companies are buying things from China, they're usually doing that to sell on into their own markets and make some profit. So if we see a slowdown in the level of Chinese exports, it means that the companies that were buying those products that were then going to sell them on to benefit their own company won't be doing that, and therefore there will be a knock-on impact to the global economy, which will be a negative multiple of between 3 and 5 times on the total global economy. This chart plots the movement in industrial production in China over the course of the last 12 months. And as you can see, on a year-on-year basis, in May 2023, industrial production increased by 3.5%, which at face value you may consider to be positive. However, when you compare this to the growth that was seen in April of 5.6%, it represents a significant fall, and the 3.5% was below the market expectations. And of course, the other thing to bear in mind is that 2022 was a particularly poor year for China. As a result of the zero-tolerance COVID policies, the country only delivered GDP growth of 3%. So when you're comparing figures on a year-on-year basis, if you're comparing against a poor year last year, you would expect to do much, much better. And interestingly, the April figure of 5.6% growth also represented a shortfall against market expectations. This chart shows the movement in China's retail sales over the course of the last 12 months. And the reason that retail sales are important is that it shows the demand within China. So this isn't just looking at what's happening in the global economy and depending upon exports for China's GDP growth. This is actually looking at the 1.4 billion consumers within China to gauge their level of demand for Chinese products. And what this shows is that on a year-on-year basis, retail sales increased by 12.7% in May. So once again, you may be thinking that sounds like a fairly good outcome. However, you need to put it into context. Firstly, the markets were expecting to see growth of at least 13.6% in May, so that represents a significant shortfall. Secondly, 12.7% represents a significant shortfall against the 18.4% growth seen in March. And thirdly, 2022 was a particularly weak year for retail sales in China. So when you're comparing the current results against this time last year, you'd expect much stronger growth. And I think this chart's a really good summary of what's happening in the Chinese economy right now. Towards the end of 2022, we saw a slump in performance, and as you can see, the growth in retail sales actually fell into negative territory at the end of 2022. The COVID-19 restrictions were then released, and we saw a bounce back in the first quarter of 2023. However, the impetus from the removal of those restrictions now seems to be losing momentum, and the concerns are that the Chinese economy is going to see another slump. This chart shows the year-on-year movement in both imports and exports for China dating back to April 2021. The dark blue line plots the movement in imports and the light blue line the movement in exports. Now, if we start with the exports first, as you've just seen, the total value of China's exports fell by 7.5% in May. And for an economy like China, which is a net exporter, that is extremely bad news. So in isolation, the 7.5% fall is obviously negative. But if we take a step back and look at the overall trend over the last 2 years, you can see that this graph is trending very much downwards. Back in April 21, the year-on-year growth in exports was around 30%. However, in the following 12 months, the growth in the value of exports started to decline, and by April 2022 was running at less than 5%. The value of exports then bounced back in May, June and July, and the year-on-year growth got back up towards 20%. However, that growth started to falter in September and October, and in November and December it moved into negative territory. The total value of exports started to fall. That fall continued in January when the year-on-year fall got to around 10%. We then saw a bounce back in February and March, and everybody at that time was talking about the fact that the Chinese economy had recovered, it had turned the corner, and was now looking at strong year-on-year growth for the rest of 2023. However, the year-on-year growth unexpectedly fell in April, and the contraction in the level of China's trade has continued into May. And for an economy like China, which is a net exporter and is dependent on exports for a high percentage of its GDP, a 7.5% fall year on year is a disastrous result. Now, in terms of assessing whether or not this is a short-term blip or something that has longer-lasting consequences, we need to look at the level of imports, because China imports a lot of raw materials which it then uses in its manufacturing processes in order to create the goods and products for export. So if we look at what's been happening to imports over the last 2 years, you can see that the overall trend is also negative. It moves almost in parallel with the level of exports. Back in April 2021, the year-on-year movement in imports was up by more than 40%. It then rose to more than 50% in May. However, since that time, the level of growth of imports has reduced dramatically. Between March and October, we saw 0% growth in the level of imports. However, in November, December and January, we actually saw a year-on-year decline in the value of imports, and the reduction in January was in excess of 20%. There was a short-term bounce back in February when we saw the value of imports rising slightly. However, in March, April and May, the total value of imports has fallen year on year. And this represents really bad news for China, because if it's importing less raw materials, that means that it won't be able to produce as much, and that will have a negative impact on the value of its exports. So the overall fall in the value of imports that's been seen since November is now likely to drag down the value of exports and will therefore have a further detrimental impact on the level of trade that China is completing. This chart plots the Purchasing Managers' Index over the last 18 months for both the manufacturing sector, which is shown by the red line, and the non-manufacturing sector shown by the blue line. And if we look at the manufacturing sector first, you can see that during 2022, the index was at or below the critical 50 mark, which means that the industry was really struggling to deliver any positive outlook in terms of growth. And this was really linked to the zero tolerance policy that was still being implemented in China with regards to COVID-19. So China was still locking down tens of millions of people on a regular basis, and that was having a direct negative impact on manufacturing. However, those restrictions were finally moved at the end of 2022, and as a result of that, we saw the PMI index cross over the 50-point level, and in February 2023, the outlook was very positive for China. However, as you can see from the graph, that positivity has been very short-lived, and it will be very interesting to see over the course of the next few months if we see a continuation of the downward trend in terms of the PMI index, or if China can manage to turn things around and bring it back above the 50 level. And if we now have a look at what's happened in the non-manufacturing sector, you can see that it's followed a similar trend. However, the levels have actually been much more pronounced. So in the first half of 2022, we saw a major fall in the non-manufacturing PMI to around 42. We then saw the index bounce back to a level of around 55 in the middle of 22. However, by the end of the year, it was back down around 42. At the start of 2023, we've seen the index bouncing back again to a level of around 57. However, over the last couple of months, we've seen that coming back down, and it's now sitting at around 54.5. So both of these indexes are following a similar trend, and the concerns right now is that they're on a downward trajectory. This chart shows the year-on-year percentage movement in inflation in China over the last 18 months. And we've got two different indices shown here. The red line shows the CPI, which is the Consumer Price Index. So that's basically prices that are paid in stores and online by consumers, so you and I. And the blue line shows the Purchasers Price Index, which is also referred to as factory gate prices. So this is the price of finished goods that are leaving factories in China. So as you can see from the red line, China has not been suffering from the high levels of inflation that have been seen all around the world over the course of the last 18 months. At the start of 2022, inflation was running at less than 2%. There was some growth during the first half of 2022. However, by the end of the year, inflation was back down to around 2%. And in 2023, those inflation levels have been falling, and the current annual rate of inflation is now at 0.1%. So basically, there has been no movement in prices over the course of the last 12 months in China. And if we now look at what's been happening to factory gate prices, at the start of 2022, factory gate prices were increasing by around 10% year on year. However, during the course of that year, there was a huge reduction in that rate. And by the end of 2022, factory gate prices were actually falling year on year. They dropped into negative territory. And that trend has continued throughout 2023. And currently, the annual rate of inflation for factory gate prices is a fall of 3.6%. Now, for anybody that's watching this who's had to live with high levels of inflation over the course of the last 18 months, you may be thinking that this represents good news, because if prices are coming down, then that means that you're going to have more money in your pocket. But when factory gate prices are falling, it's bad news for industry, because over the course of the last 18 months, we have seen global costs rising. The price of oil and gas and food and a whole host of other commodities rose dramatically during the first half of 2022, and those prices have remained relatively high when you compare them to where they've been sitting over the course of the last 5 years. So the problem that Chinese industry is now facing is that its costs are rising, but its factory gate prices are falling. So Chinese companies are currently selling their finished products for 3.6% less than they were this time last year. However, if you've had an increase in costs during that period, what that means is that you're having to absorb all of those cost increases yourself, and therefore you're making less profit. So what's the summary and conclusion today? Well, I wanted to post this update on the Chinese economy really to let you have the latest figures that have been released. And what we've seen is that there is rising concern. The latest figures show that industrial output and retail sales have both come in significantly below market expectations. And the economic trends in April and May are very worrying signs. One of the biggest surprises was the 7.5% fall in exports in May, because the Chinese economy is entirely dependent on exports. And the concerning factors from China's perspective are that the reason for that fall in exports was a combination of a slowdown in the global economy, so a reduction in demand for China's products, and also internal issues within China. And when you overlay the 4.5% fall in imports seen in May, there are lots of red flags being raised, because China needs to keep importing lots of raw materials so that it can feed its processes to make sure that it's got enough finished product to be able to keep feeding the export machine. So when we see a drop in imports for China, what that means is that it's going to have a direct impact on the level of exports over the course of the next 3 to 6 months. And that fall in the level of imports is also reflected in the Purchasing Managers Index, which has now dropped below the key 50-point indicator and tells us that Chinese manufacturing is currently in decline. And to make matters worse, the Chinese economy is now seeing deflation. The consumer price index is running at virtually zero, but factory gate prices are down by 3.6% year on year. So what that means is that Chinese businesses are actually selling their products for less than they were this time last year. And of course, global costs have risen. So what that will mean is that all of those companies will be making less profit. So from a Chinese business point of view, we've got a horrible combination of a fall in the price of your exports and also a fall in the total value of your exports. So both of those factors will hit the profitability of those companies, and of course that will then have a negative multiplier effect onto the Chinese economy, because if a company is making less profit, that means that the company at some point will have to cut its costs and potentially reduce its workforce. That means less employment, less people with money to spend in the economy, and so it goes on. So all of this is obviously bad news from China's point of view, but as I've mentioned on multiple occasions, China is the second largest economy in the world, and so when we see a slowdown in the Chinese economy, it will have a knock-on impact to the global economy. The current forecasts for China's full-year GDP have been cut back based on what's happened in April and May by around 0.5%. And as I mentioned earlier in the video, that will have a negative multiplier effect onto the global economy, because China is both buying and selling things from other countries, and if the value of what it's buying and selling reduces, then that means that the counterparties that it's dealing with will have less sales and purchases, and so that will have a negative impact on those economies. So unfortunately, the slowdown of the Chinese economy will have a direct negative impact on the global economy. So the overall summary of today's video is that despite the removal of the COVID-19 restrictions at the end of 2022, which looked like it was going to result in major growth for the Chinese economy, over the last couple of months we've seen very worrying signs that the Chinese economy is now slowing down rapidly, and we now have a negative outlook for the rest of 2023, and unfortunately the slowdown of China's economy will also mean a further slowdown of the global economy, and it's possible that we could see a number of countries moving into recession over the course of the next 3 to 6 months. So I'll keep you posted on any further news and data as soon as it's available. Hopefully you found today's episode useful, informative and thought-provoking. If you've liked what I've said, then please give me a thumbs up. Thank you for watching this video all the way through to the end, and here's something to put a smile on your face.